Eric,
All right. So Peter's principle, right?
I can't hear you.
Ah, all
There we
right.
go.
There we go. Um, you cannot hear me.
I hear,
Okay.
I hear you now.
Excellent. Okay. Well, so today's game of yield got kind of delayed. We we had technical difficulties, and the subject that we were going to discuss was technology. So there's some irony in that.
Yeah.
Right? And but you know what? I think that basically being self-aware of glitches and the fact that we are not really, you know, I'm not really an audio engineer. My son is, right? So quite honestly, sometimes you got mini crisis. Um, you want to deliver content that people want to consume, but devil is always in the details. So what I wanted to discuss today at Club Dividend Detective in some detail is what we, and when I say we, I mean you as a licensed portfolio manager and me as an ex-advisor, what do we offer? And the reason I'm saying this is very simple. Um, I'm sure that AI will remind me in 3 seconds, but the most famous marketing firm on Wall Street catering to Morgan Stanley's of this world basically said that there's two things that anybody offering any financial service should be able to deliver. And if you don't, you're dead in the water. And these two things are positioning and promise. And positioning answers the question, what is it and what does it do? And the promise is, how is my life going to be different in this before and after I got to pay attention to your offer? So unless you want to discuss politics or religion on all of these taboo themes, which I doubt, why don't we talk about that?
Sure, no problem. I guess around positioning, it's very important to be clear to the client what it is that you do, and what we do at Pensionize Me Wealth Services. Our position in the market is essentially we are a regulated firm under CIRO, which is the old IROC regulatory body. And we have Aviso as our back office. So Designed Wealth, which is where I operate Pensionize Me Wealth Services, has Aviso back office at the end of the day, which is run by the credit unions and insurance companies. So it's a very large organization, and assets are safe. So the positioning is this: because I am independent of any bank-owned network or other advisory firm, I have a lot of latitude as to what I can do for clients. Now, that doesn't mean that we're cowboys or anything. It just means that there's a toolbox. And I had a friend one time describe it as, when he went independent, was, you know what, when you're working at a dealer, a bank dealer, you have a toolbox, and the toolbox will be fair size, and you have everything open to you. Or if you're at an insurance company type of dealer, but a lot of times you end up seeing a lot of their in-house product being sold into those accounts. The toolbox that I have available to me is essentially almost like walking into a garage, where if you need a specific wrench to do something, we can find it and put it into place for you. Like we'll find those things. So that's the positioning in terms of what Pensionize Me does from a product perspective or from a solutions perspective. The second thing that we do is that we are very competitive on our fees. So people ask, how can you be so competitive when everybody's charging, over 1% or 2.5% for their fee structure? We leverage technology like crazy. Recently just onboarded a client. The only paper I touched was his statement to scan in and attach it to the workflow, which was all digital. So within the digital workflow, everything was in there, from the KYC, which is knowing your client, getting the address, everything else, to risk tolerance, to the banking and everything. And then we just attach these uploaded statements. So it's essentially paperless and all done through a secure network. So that's really the proposition.
Well,
rather the position.
You know what? I'm going to be I think I'm a reasonably difficult person, no matter what. But I'm going to be difficult.
Okay.
I'm going to play the devil's advocate. Devil wears Prada. Let me change for theatrical effect. Let me just change the glasses. It is Prada,
okay.
Right? It's technology. It's actually better glasses. So you described to me a couple of things available to you, which as a marketer, and I became a marketer not when I stopped being an advisor. I became a marketer when I was still an advisor, right? And I think what you described is admirable, nice to have, but they are not the main benefit. They are not what you do, what Pensionize Me does. I think what you described is officially normally called features. You have nice features. Great custodian is a feature. Well, it's assumed that the money is not going to go anywhere, right? But it's good to know that most of the credit unions are using the same. You are not alone. Designed as a new firm, independent, passionate about it, but it's good to know that the capital is safe. They are not the first ones to trust clients and their 200 plus advisors reputation to Aviso. So in a good company, right? Toolbox and independence, and you are not tied to the in-house made product, which basically would be just like a warehouse of stuff behind you, and you have to sell it because there's pressure, right? But in a nutshell, the client says, what can you do for me? Or what have you done for your existing clients lately? And what's the shortest answer?
What can I do for you? So essentially, it comes back to the toolbox. So the way it starts with any client or prospect is you need to figure out what's wrong. So I know you're a tennis buff. I like to use a golf analogy.
Yes.
I don't know what you need to fix your situation, to make it better, until you figure out your swing. So I could offer you Tiger Woods golf clubs. I like using Tiger Woods because I think he's still a great golfer, even though there's new guys that are coming up through the system. But
new guy Rory just won the only thing missing, right? I'm still following, but anyway, continue.
I always use the analogy with Tiger Woods, as I would with Michael Jordan. I just like those two guys as athletes, but it shows my age. But I can offer you.
You don't have to hide it.
Yeah, I could offer you Tiger Woods golf clubs, but is that going to improve your game? No. Unless you have the proper swing and mechanics, it doesn't matter what clubs are for you, it's not going to work out. So the way I look at it is, let's look at your swing, let's look at your system and what you're doing now, and then the solution, what I can do for you, are actually the clubs. So I can then go to the pro shop, and my pro shop, let's call it that toolbox, let's switch it down to a pro shop. That pro shop, I can go in there and select whatever I want off the shelf. I can sit there and I can grab a very specific driver. I could buy a very specific 1 iron, 2 iron, 3, all the way. I can buy whatever, and I don't have to buy it in a set. I can buy whatever I need to meet your solution. On top of that, we also have a customized solution. We do have a monthly pay closed-end fund strategy, which is very successful. It's not for everybody, but it's there. It pays in US dollars. It's monthly pay, and we package that up for people. So what I can do for people is, first of all, let's figure out what's wrong with the swing or your situation. Let's see what needs to be done to correct it. Correcting it is going to the pro shop and selecting the right instruments or clubs, whatever you want to call it, tools to get things going for you. So each portfolio is customized. I've mentioned this before. and the core. There may be some overlapping commonalities between clients, but then it gets different when we move up from a core to a satellite, where people might want to explore different areas. I mean, I have business people that are clients that are very technology literate, and they're saying, you know what, I want my extra exposure in technology. It may be a specific stock. It may be just a technology sector. So we'll overlay that on top of the core portfolio. So really what it comes down to is it's bespoke. It's like, building the clubs specifically for you, each club individually, making a suit for you that fits just right. Wherever you want to look at it, it's done for you. Or I guess in the tennis analogy, I could get a custom-made tennis racket with whatever strings I want and a specific grip and so forth.
Well, you just nailed it for me in a sense that I think I had maybe 3 custom-made rackets, and I think in sports manufacturing there were about 3. One was called Zeus. There were 2 more I can remember, or I could again use AI and find out again, refresh my memory and remind in 3 seconds, which is amazing, actually, kind of an extension of your forgetful mind. But as far as product and what it does, custom-made racket is still done for one thing: hitting that damn ball, right? The same with a golf club. So the ball here, to me, is part of the name of our podcast and of our process and of our game, which is yield. Unless something, and the secret, I'm going to reveal the secret. We know each other for 6 years. It's been that long. Our index is 5-something years old. Time flies. And yet, 6 years ago, we were simpler than today. And we said, you are a mobile income specialist. I know that that doesn't limit you to doing pretty much anything else. You know how they say, for somebody who only has a hammer, everything looks like a nail.
Yep.
That's not what I'm saying. I know you have a toolbox, but everybody is best at something. Stradivari was not making cellos. My grandfather played cello, but he wasn't making cellos. He was making violins, right? So what is it? What is your violin? Or my grandfather's cello?
Yeah, so I guess at the end of the day, where our key specialty would be dividend income or just income generating, but also in a tax efficient manner. So knowing where to place a certain dividend or income generating products, which account, what type of things to look at. Could be everything from straight up dividend type ETFs to the closed end funds that we buy dividends at a discount, where the net asset value or the total cost of the units might be $10. If we can get them for $9.50, why not? So we always look for those opportunities. We may also use a covered call strategy. And in this market right now, where it's choppy and very disoriented, sometimes these covered call strategies work out very well, because what we're doing is we're harvesting, if you will, or we are being paid on the volatility. So we're being paid for the volatility in this market, because the premiums for these options go up. That adds to the organic dividend that we're getting from the fund as well. In the closed-end fund space, that volatility also presents opportunity. People tend to drop investments and run away, what I call run away back to cash, or try to get out of the market, which is not the greatest thing to do. You have to know what you're doing to do that. So you might be able to pick up that, when I said $10 to $9.50, instead of $9.50, you might get it for $9.25 or $9, even a further discount. So these markets provide huge opportunity for people seeking to increase their income from their underlying holdings, be it stocks, the dividend ETFs, the covered call ETFs, or closed-end funds. So really, we focus on income.
You know what I just noticed, and a benefit of us being at it for some time is as follows, right? I don't have to frantically go and look for illustrations. We have a ton, right? We had an in-house illustrator, and we pretty much know what we can show and what we will later splay on top of our discussion, right? When it's appropriate, because we don't tell on this show, we show,
Yeah.
right? That's one of our mottos. We show. So I know that we are going to show them a little station with A, B, C, and D, and an inspiring slogan saying, you know, playing to win. And on station A, there will be a cat. And on station C, there will be a Great Dane, a dog, your avatar, your dividend detective. He's cute, right? And he's on station C. So what is C in my mind? Cash flow, coaching, CEF, consultancy, right? You see how it all goes into that particular letter, because basically that's who you are. You're the chief consultant. Sherlock Holmes was the world's only consulting detective.
Yeah.
And that's what you are. I think if you ask both of us who we are, first and foremost, we are consultants. We have certain specialized skill sets. We can apply them to solve a lot of problems, problem solving, but the problem that you solve most often, I think, is cash flow. Again, and optimizing it. 4 quadrants. You know, the court also C, the club also C. We are normally solving the problem of who gets their money first, who's second, and who is in which quadrant of Kiyosaki's famous 4 quadrants. Do you see yourself as a person who consults people on that? And also, the before and after, I think your before and after is this. First of all, they will never be alone anymore, you know, dealing with their retirement revenue. And secondly, you have experience about, you know, directing them into the proper quadrant where basically their cash flow is optimized, where the registered funds become unlocked legally, where we deal with retirement realities, rules, and regulations. And that's one of my pet peeves, because I think they are unnecessarily complicated. All the initiatives before the elections, which will be over today and tomorrow, we will know which of these initiatives will make it and which will die, right? So today, discussing what 2 parties that are most likely to form the government is ridiculous. Tomorrow we're going to know. But whoever wins should probably do something radical. And that's my radical truth. And that's my devil in the details. Like, look at this thing. Do you think it's overly complicated? But on the other hand, it gives you so much space for being a consultant.
Now, I think in general, and I've been doing this for over, it's coming close to 30 years now, the industry likes to overcomplicate itself. I hear so many advisors addressing, or have in the past, advisors addressing prospects and clients, positioning themselves as, you have to come to me. I know everything and you don't know anything. And people kind of bend the knee to that. I take an opposite approach. Yes, I'm very knowledgeable. In my 30 years of experience, I've been through bear markets. I've been through bull markets. I've seen the best and the worst of this. Haven't seen a 1929, depression, but we got close to, great financial crisis was certainly something that came close. But I think our industry overcomplicates the business as it is. My approach is a lot different. First of all, I'm all about education. So the more you want to learn about what we do for you as a client, when you become a client, the easier my job becomes. Because when we enter markets like this, where we're up and down, like I hate to use the analogy, like a toilet seat or a yo-yo, my clients aren't calling me in a panic. They're calling saying, do you see opportunity? Where is that opportunity? If I had extra money, where do you think you would put it? Let's talk about it. So they have been, I don't want to say trained, but they've been educated to such a degree that they're not that they're comfortable, because nobody likes to lose money or watch their account values go down, but now they're seeing it as an opportunity set to do something. So the way we approach it at Pensionize Me, the first thing we do, you mentioned the 2 parties, and tomorrow we'll find out which one will be moving forward with their propositions and changes. The first thing you need to know, and we do these 4 questions, the first thing you need to know is, are you retirement ready or not? What rate of return do you need to earn to be able to retire at the current level that you're earning income for your life, for your lifestyle, and for your life expectancy. The second thing is, how much money do you need to put away? Are you putting away enough? We'll find that question out. The third one is, do you need to possibly lower your retirement expectations? Do we have to dial that back from current expectations? And then lastly, do you need to work longer? So it's really what we do this is in our 2020, so a 2020 view of your situation in 20 minutes. It's not a detailed plan or anything or a strategy. It's just like, where are you today? Do you need to make changes? And what could they be? So we take it from there. And then the next area that we start addressing once you start coming on board is there are 5 areas, and this is that consultancy part that you mentioned. There are 5 areas that we really focus on for clients because there's 5 areas where you're losing money unknowingly and unnecessarily. Has nothing to do with your latte that you're buying every day, or your gym membership. If you enjoy that latte, have it, because that might be the best part of your day. So we're not telling you to cut that out. But number one, the biggest area where you're losing money could be tax. We all have to pay tax. There is no reason that you should pay more than you have to. Now, deductions at source are one thing, but then there's tax on income earned through portfolios and so forth. So how do we make your situation more tax efficient? Maybe as a self-employed individual, we can actually find out situations where you can make tax efficiencies. The second area is on mortgages. A lot of money is lost on the mortgage side of the business. So first, it's taxes. Second, it's mortgage. The third area, and you kind of touched on it in a roundabout way, is retirement. Retirement savings is a tax postponement. So yeah, you're getting that tax deduction up front. You're getting that tax-free growth, but all you're doing is postponing tax. And regardless of who comes into power, who knows if they'll turn those dials on taxes. And it doesn't have to be radical changes. All it has to do is turn the dial on the marginal tax bracket and the marginal tax rate. So those are little things that can work. And then there's two last areas, Yuri.
Yes.
The next one is RESPs for people that have kids or grandchildren. They want to save for education savings plans. There are tax efficient ways to do it and access to capital in case the kids don't go to school. And then lastly, how you pay for a major capital purchase. So a major capital purchase is something that you cannot pay for in cash from your monthly cash flows. So if you're able to afford a $50,000 car, great. From your monthly cash flow, if you can buy it cash in 1 month's earnings, that's fantastic. Most people
aren't. That guy wouldn't come to you to solve cash flow problems, apparently.
Well, right? That person would probably come for tax problems.
That's right. That's exactly it.
So that one thing they've got nailed down, but they maybe have leakage on the other side, which is the tax efficiency. So really, it's all about taxes. It's about mortgages. It's about retirement savings. It's about education savings, and then lastly, major capital purchases. So you start putting that all together. That's the consultancy side you touched on.
I'm gonna be a difficult smart aleck again, and I would say all of these things that you numbered here, and yeah, all of them have one thing in common. Most of the time, all of this stuff, solutions are done by default. And I know you heard this before, and I know it sounds like a broken record, but first of all, Richard Thaler, who was the early noticer of closed-end fund arbitrage, how effective it is for decades, because people are irrational, and also won the Nobel Prize of Economics for nudge, telling how to make people make decisions that retirement industry wants them to make. Basically, he's famous for saying that consumer is ignorant, lazy, and loses like a shirt, an arm and a leg, because of doing things by default. Unknowingly and unnecessarily. It's not even procrastination. It's just, again, favorite example. Age 71, or as they are now saying, 73. Oh, if it's 71 and at 71 I have to, then I'll do just like all the other people. Oh my God. It's one of 10 or like numerous other opportunities that you have since age any, by the way. You can have a RIF at any age. And most people have no idea if it's good for them, bad for them, neither, right? And we come again back to consultancy, right? Now, if you're at station C and I am at station A of our platform, right? I see myself now as agitator, or you can call me advertiser, or you can call me, I don't know. I'm just saying, guys, there's something new. I've been doing this for 20 years, right? There's a portfolio manager who understands this and who offers it on a platform I didn't have. I wish I had the chance actually to be on that platform because it's light, you have low cost, and you share it, right? You are not linked to a product, your objective. There's no pressure on you to create revenue except for pressure to be successful yourself, which you will because you have the best product and the best platform. And you're an amazing professional. And I'm not saying these things lightly. Obviously, what I'm saying should be discounted because I'm now a professional marketer. But the best marketing is don't ever offer what you're not using yourself. Right? Another thing is when I was leaving and there was a need for somebody to take that torch and take that strategy and build that ETF, which we planned like 6 years ago and now decided that direct indexing is better. I picked you. You evaluated my strategy and we found common ground. We found a lot in common. We were a good match. And I think, again, good match is something that we're going to talk about later. But initially, you and I were not a bad match because we were solving the same problems, basically. Income investing, cash flow, tax optimizations. In other words, all the problems that a person with 6 or 7 digit balance in registered accounts typically encounters because of how our retirement system was built. And when I worked at Macquarie, which was an Australian firm trying to carve out a market share in Canada, guess what they were targeting?
Retirement people.
Retirement people with large balances in their RRSPs. I'm an insider. They fought valiantly for 4 years. Now, they didn't make it. but you know what? That should be a subject of another podcast, basically. The almanac of Canadian industry failures. But let's go back to what we hope will be a success, right? So, pensionize me. What's the big promise then? Before and after, typically.
Well, the bottom line is with Pensionize Me is that we will endeavor to the best of our ability to create a pension-like income for your retirement, for your life expectancy, and do it in a tax-efficient manner. Now, that's really honestly just table stakes. I mean, if you go to any planner, any advisor, they'll tell you the same thing. What's unique is we will look at your situation specifically. You're not going to be put into a certain category of, well, here's your income portfolio, here's balanced growth, here's growth, and here's aggressive growth. We don't do that. We look at what is your goal and objective, how do you want to achieve it, and then we look at how it's achieved in the best manner possible. So we call it more strategizing because that can change on a dime. So as an example, this account I just brought on recently, it's this one is specifically all in equities and ETFs. But what we're going to do there, this person is single, they have no family at all, and they have a healthy pension at the outset with CPP about to come up. So what we're going to do here is we'll probably end up delaying CPP and old age security, melt down the RSP for this person, and then at 71 or 73, depending on who gets in the power here, we will then convert to the RIF and start drawing on that. Sorry, we will then let the old age security and CPP increase in value because you're deferring it. start drawing from there after the RSP RIF is gone. And then we have a TFSA and an unregistered account still to work with. So this is a unique situation, and it comes down to each person's situation. So if you've got loved ones, you have health issues, that's a different strategy altogether. So you really have to fine tune. So instead of using a shotgun approach to retirement planning, it's really laser sighting. It's like literally like you see the movies with a red dot or green dot on the forehead. That's what we do is laser sighting. This is what needs to be done, and bang, as opposed to firing a shotgun and hopefully, it scatters enough that we hit the target. We're actually really trying to laser it down and get that going for you in a tax efficient in a manner that achieves your goals and needs. So that's really the promise. So before you're stepping in, you're showing me what you've got. We'll figure out those 4 retirement questions I mentioned. We'll look at the 5 areas of where you're losing money unnecessarily, and then we'll put a strategy in place that suits that situation. If your personal situation changes, that's when we start changing strategy. When you're in a market like this, you don't necessarily change the strategy, maybe change the composition of it, because what got you here before this tariff issue, which is self-inflicted, may not get you out on the other side. So you may have to make some adjustments within the portfolio or the model itself, but you don't blow it up and go to cash. I've seen people talking to their advisors say, "Oh, we went to cash." Well, good luck trying to get back in the market. When are you going to choose that time? So it's all about what have you got, where do you want to go, and then let's get you there. And that the laser approach is what we use.
Now let's change the subject a little bit and go back again like 5 years ago, but we will still like get stuck in letter C. Do you remember the publication called Canadian Capitalist?
Vaguely, yeah.
Yes. So speaking of, capital, speaking of net worth, speaking of tools that you are using to preserve personal capital of clients and prospects, basically, right? Why don't we open this curtain a little bit and talk about the toolbox? Because, yeah, okay, so we now covered what is it, right? What's the service? We reveal what the promise is. Basically, plans without funding are just that, plans, right? But what is it that we have as far as tools? And I know that you have at least like, 3 that most other advisors who probably charge more don't have at their disposal. Why don't we go a little bit again into details?
Yeah, so again, the toolbox is as big as what the market has to offer. The only area where there could be some restriction is what we call the alternatives universe. So anything like that would have to be approved by the firm to be offered to clients. And we do have alternative products that are not correlated to markets. So in other words, they don't go up and down with the markets. They're specific carve-outs. I'm always of the opinion that I like liquidity, and most of my clients like liquidity. So there are some that are alternatives that have daily liquidity. Others have sort of a 30-day notice or 45-day notice or quarter end then notice. So it all depends, and those things can end up helping buffer the portfolio. So there's alternatives that we offer at Designed at Pension ISME through Designed Wealth Services, and I've helped bring some of these alternatives to market for these people. The other thing is whatever is marketable, I can pretty much buy. So if it's listed on a stock exchange, especially in North America, it's not an issue. So call it bonds, call it ETFs, call it closed-end funds. I can buy anything I need. So the easy part, what I'd like to think the easy part is constructing that portfolio for the client once we figure things out. The edge that we've got is, and you mentioned it, for a higher price, people are doing things. Well, what we do is we have the closed-end fund strategy, and you kind of touched on it, direct indexing. And for people who don't know what direct indexing is you can buy a mutual fund or an ETF or whatever it may be that represents a specific index. And that index could be 30 names, 100 names, 1,000 names, whatever you can think of. Direct indexing means that we actually can go in and pick off those names specifically and create that for you. Now, is that for everybody? Not necessarily. For larger accounts, we can do that. And it now changes the cost basis or your tax cost basis for direct indexing. It's a lot more time. You can time your tax a lot better with the direct indexing approach. So direct indexing is one thing that we do have. Some people say it's a glitchy or glitchy.
It's a fad, yes, but you know what? We can simplify it for people. We can give them an example of where direct indexing would immediately replace some of the popular investment vehicles, like
so choose any
like certain type of ETFs
Yeah.
could be easily recreated directly at much lesser cost without actually losing much of the ETF pluses or advantages. Wouldn't you agree?
Yeah, exactly. So you could choose essentially an ETF. So there's a couple ways to attack this. You could look, the most difficult one would be, say, an equal weighted ETF. So if you choose an equal weighted ETF of the S&P 500 to do direct indexing on that, you should have a very large account. Like
That's pretty much impossible unless you have a team like a size of a hockey roster.
Well, no, it's not. So the direct indexing on that it's not impossible. Where the limitation is on money, right? So if you want me to direct index the S&P 500 equal weight, we're talking a very large account. Like we're talking well into 8 figures to do something like that. Okay,
that's true. It's 500 components. But I was thinking, I'm sorry to interrupt. I was thinking more like 5 or 6, depending whether national goes. Canadian banks. You put them together, equal weight, 6 of them, and why wouldn't you go direct indexing? Why would you want to buy an ETF where inside of that is hidden, 1.5% MER for what?
So yeah, that's where I was going with it.
Right.
So the S&P 500, that you have to have a large account. But as you just mentioned, if you have a portfolio of say 10 stocks or 12 stocks in an ETF, we can easily replicate that if that's what you like, or if that's what you're looking for, or if you don't like the ETF wrapper. So we can just sit there and buy those stocks in the weightings that they are in the index and run it. And like you said, now you've peeled back the layer of the ETF or the wrapper. With the wrapper's peeled away, and now you're just left with the actual fruit or the meat, whatever you want to call it, inside. So you've peeled away the wrapper. Now you've got the actual things that are doing the work. And with that, like you said, you could be saving on the MER. Now, some of these MERs are rock bottom prices anyway, but still, at the end of the day, it comes down to total cost of ownership. How much you're paying for your fees with your advisor, how much is your MER, and so forth. Not to mention, when you get into any kind of wrapper of ETFs or anything else, there's always potential for tax liabilities and tax distributions that you have to be prepared for. But for the most part, ETFs are good. But yeah, for those clients that want true customization, direct indexing, we can build that out, no problem at all. And I don't know of many advisors that would do that or not. The other thing is, with direct indexing, we can actually create a custom index. So if someone,
which leads me to the tool called CMP, which we could mention briefly, but we could actually even come up with the index idea and create a new one.
Yeah. So for example, someone could come up and say, I want an index on agriculture, and be very specific. So then what we could do is create a specific index for that client based around agriculture. So that's that direct indexing or custom indexing approach. So essentially what you're doing, there's a lot of indexing services out there. There's, Russell has them, S&P has them, Solactive has them. That's where our index is sitting, the closed-end fund.
Yes.
So you can actually, pardon me, use the CMP tool to create an index for a client. You can actually create, if you want, a balanced, for lack of better words, a balanced index where part is equities, part is fixed income. And that fixed income can actually be made up of ETFs. There's some really cool products out there now that are term certain ETFs where you can buy.
I know where you're going with this. I think the maturity, all of a sudden, bonds got maturity in an ETF. Like
Yeah,
you should probably, go delve into this a little bit deeper. This is extremely interesting.
yeah. So I mean, traditionally, it was always easy to attack a portfolio that had a bond mutual fund or just a bond ETF because you'd sit there and say, okay, you're putting $100,000 in. What is it going to be worth in 5 years? Well, we don't know exactly because that bond ETF or bond mutual fund will have varying maturities. It'll be actively managed. It'll keep rolling over. We don't know what's going to happen. With the term certain ETFs on bonds, we can buy them at a discount. Again, it's harvesting for those discounts. We try to buy them at the discount to the maturity value, and we'll put in 100,000, and we know that in a year, 2 or 3, depending on the term, we'll have 102, 3, 4, 5, whatever that number is. We have to look at it. So you've now taken a market that you probably couldn't have access to of varying credit quality, put it into an ETF, and now you have a maturity date on it with a maturity value. That's the most important thing. The mutual funds and the other ones just keep rolling and so forth. So this really changed the market, and they're not popular yet, but I already started using them in a few accounts, and people are liking them because we're putting in X. We know we're going to get Y or X plus the interest at the end of the term, and then we roll it up again. It's even more interesting when you start dealing with people that not everybody has one, but a personal pension plan where there's a strategy called dry powder strategy, where in markets you can park money into the call it the low return but safe term certain ETF. When markets sell off like they are now, you can actually sell that bond or sell that ETF, roll it into the equity side, and then once the equity side takes off, sell that down and go back to term certain bonds again. Now I've really gotten ahead of myself. It's not, again, everybody has a personal pension plan, but those are the things that we can use because within a personal pension plan, there's required rates of return. So if you're underperforming, you can add money and you can start making some really cool changes.
I just thought about one of the cool changes. Again, cool changes start with the C and with the C. So I'm thinking about the term certain bond ETFs, and I'm thinking, let's say that it matures 2 years from now, and equally weighted, and there's 50 issuers, right, or something like that. If that ETF on its way to maturity, which is 2 years from now, dips, but the constituents are not going bankrupt, in droves, I would probably dollar cost average into that vehicle like there's no tomorrow. Like, sorry, kind of. Wouldn't you?
Yeah, it's no different than buying the closed-end funds at a discount, right? You're
Especially the one that has, like in Canada, that has a maturity annual redemption date, right? That's the nearest analogy.
Yeah, exactly. So it's about looking for opportunities and doing it. There's again, our industry overcomplicates the business, and some of these products that we're talking about sound complicated, but they're actually very simple. And once people get to learn how they're used, so how that club is used in their game or in their retirement game or retirement strategy, they're like, wow, I get it now. And it's very cool when that happens, when you start discussing things. So that's why for me, education is the most important thing around the types of products that are being used and how they operate. And I always make sure they understand it. And if they don't really understand it, then what we do is we start legging it and say, okay, you know what, let's take a portion, let's show you how it operates. And then when they see how it operates, it's okay, now I'm getting it. And then they just start picking up. And like I said, in this market, the calls I'm getting are, where's the opportunity? Like, what do we do? Like, where do we go next? And it's a little bit difficult given, that everything's related on a tweet, but we try. We try to find out where things are going to go next.
Interesting. Well, you know what? We were stuck on letter C, and the CEFs are a conundrum. We didn't talk about that because we talk about this particular subject, like, almost every time. But the phrase, assets for nothing and yields for free is catchy. That's why I just kind of want to kind of pronounce it again before we actually go from here to next letter. And that letter is D. And D is for not just discounts, but also for deliberations and debates, and the double header. And this is something that you don't know, because, I'll just reveal a little secret. Me and Ray, we decided to stick to schedule, to not go with our live podcast over, 45 minutes or an hour. And I just got a pop-up on my Zoom, which said Liberty 55, deliberations, discussions, and debates, double header. So what is a double header? A double header is our discussion, research further, animated, and then we add that details, factology, and tools like artificial intelligence tools, all kinds of tools. There is no tools that are not intelligent anymore. There's hardly any piece of software that doesn't have some element of this language processing algorithms, or call them like whatever. So basically, what else we have here between letters A, B, C, and D is integrations. We create content, we educate, we share, and we dispatch our daily updates from Club Dividend Detective. And Liberty 55 is the idea that we can deliver gamified education in compliant, diligent way that basically will be properly addressing the very serious issues like regulation, licensing, being a part of the industry, which is complicated and touchy and extremely big on confidence, and yet make it what I call edutainment, right? And this pop-up is just a reminder that it seems to me that as much as we are Canadian and patriotic, and as much as is being decided today, and how we look across the border, and think tariffs and Trump and this and that. Do you want to comment as to us being somewhat behind as far as development of the industry, of the independent advice, of the registered independent advisor, and about the fact that this has to change? The only constant in this world is change. You shared today with me that the real question is not what's going to change in the next 5 years. The question is what is not going to change in the next 5 years. And my question to you is what Canadians, savers, the poor millionaires and simply not millionaires, registered or not, what are the biggest changes you see happening in the industry in the next 5 days, in the next 10 years, in this life after employment, which is called the retirement, and the fact that the challenge is longevity and constant change? What do you see coming?
Well, I wish I knew if I did, I wouldn't be sitting here. I'd be on a boat in the Caribbean. Next 5 days, I have no idea. The time frame is too short. But in terms of the industry, you mentioned us lagging. Yeah, I think we have lagged. Canada is getting better. We're adapting quicker with some product. So some product is being introduced, or that whatever's being introduced stateside is showing is beginning to show its way into Canada quicker. I'll use this as an example. Mutual funds were big stateside. We loaded up on mutual funds in Canada, and then the US started switching to SMA accounts, separately managed accounts, which is kind of the direct indexing of the mutual funds, but still kind of a pooled approach, but you see each name individually. So that's where people started getting those statements that were 40 pages long with 3 holdings of everything, and maybe 20 or 10 of something else. So SMA accounts was the one thing. Then, even though Canada was the first country to introduce ETFs here, or globally, we're the first country to actually introduce the ETF, the states really took it and ran with it. And that's where you have things like SPY, which is the S&P 500 ETF. And then it just it took Canada a long time to adapt to that, because advisors were not compensated for buying ETFs. They always wanted to get paid. The biggest issue in our business has been, show me how I'm paid, and that will show the behavior of the advisor. Mutual funds were big because a lot of people made advisors. A lot of advisors made a lot of money on deferred sales charge mutual funds. Thankfully, that is gone. Those deferred charge sales mutual funds are gone. But show me how I'm compensated, and you'll see the behavior of the advisor. So that's why ETFs took a while to get going. But with education, clients are beginning to realize that, an ETF is exactly the same wrapper as a mutual fund. The difference is it's a lower cost. So you might have a mutual fund with a 2% MER. You can buy an identical ETF for maybe 0.5% MER. So that's the first change. Now let's get on to how the industry is looking. The dealer network is traditionally dominated by the banks, and they like to squeeze competition out either through acquisition or through a regulatory environment, where they make it so difficult for a small firm to try to survive and introduce competition to the market. They don't like competition, because when you have a big dealer, it's like an oil tanker. You cannot turn quick enough. RIAs, or independent advisors, can make and adapt quickly, and we adapt to technology quickly. I mean, the dealers that I've worked for, a lot of it was paper-based back in the day. After I left the bank network, the dealers I worked at were digital onboarding. Like right from the outset, it was like, you want to do something, it's digital. Instead of coming to a client with a stack of paper 2.5 inches thick, it's one email. They just sign off after they review the documents, and that's it. So what I see happening is the advisors are being shackled at the dealers. They can't speak their mind or what they want to say, because it may conflict with what the dealer says, and they're looking for something else to better serve their clients. With Pensionize Me Wealth Services at Design Wealth Management, I'm allowed to speak my mind. Like, obviously, we have to know the rules, which I do, and you just keep your discussion within those rules. That's why we never recommend product. We never discuss product. We discuss concepts, but we'll never talk about XYZ ETF, XYZ mutual fund, or what have you, or any stock, because now we could be heading down the road of recommendations. So I see the independent network in Canada gaining a lot of momentum as people realize that, all those beautiful glass towers that their advisors in, they're paying for that through their fees. And hey, I was in that glass tower. I had the corner office. I had some neat stuff, but it's just like, who's paying for that?
I'll tell you what, we have an American counterpart, at least my counterpart, because she's in marketing, right? And again, I don't want to name names. I don't know, because I haven't been authorized, but this lady's tagline is "Been there, done that." Yeah. Right?
what I like to say is been there, bought the T-shirt. Like it's there. So we understand that change is a very difficult decision to make. So that's why we make the process very easy. So it's not showing up with your brie bag, this thick, full of paperwork that requires 50 signatures and initials. once you've got it all done, it's a nice package that comes to you by email. All you have to do is review the details. Always tell them, just review everything and make sure that first of all your information is right, because it still requires manual entry at the moment, right? So my big thumbs may have hit the wrong key or something. So just make sure the details are correct, and then build from there. So we try to make that change as comfortable as possible, with as little pain as possible. Like that's how you do it. And sometimes change is good because you need to see what it's like to operate outside of a closed ecosystem. Once you see what's available, because I have clients that'll call me middle of the day for no reason, and they'll say, hey, you know what, I'm thinking about doing XYZ, whatever it might be. What do you think about that? And I say, okay, so we'll just start discussing how do you plan on financing. What were your ideas of how you wanted, let's do the major capital purchase. How were you thinking about acquiring this piece, this asset, whatever it be, real estate, car, whatever it is. How did you want to approach it? Well, I was thinking about doing this or that. So then we'll actually work through the discussion, and we'll discuss the advantages of how to approach that purchase. And then they'll say, okay, let me think about it. And then they come back and they'll either agree with what I say, and they'll say, well, I feel more comfortable doing it my way. Great, fantastic. But at least we've laid it out. So it's not just a one-way street where I'm just talking to them about investments all the time. People are calling me about, how do we finance certain things?
But you know what? There's a thin line, like, blurred line here, probably between bucket lists and irrational from the point of view of cash flow desires. But on the other hand, that pot of gold, that retirement time, all that retirement dreams, right? There's a certain ethos about the idea that finally, I'll be free to do whatever I want. And this is how retirement is, again, as an advertiser. This is how it's being advertised, right? This is the promise of the time when you will have time to get to know yourself, to see the world. That's the big promise of retirement, right? Again, we're coming back to the big promise. And what I'm saying is this. Where is that line between, you know what? I don't like you. I don't want you to take that cruise or that dream vacation or to gift this thing to your grandchild, right? Because I'm telling you, you can't afford it, or it's going to cost you, and or you have to accommodate because we only live once, and retirement dreams are basically the goal, the purpose, and what actually made all this planning worthwhile. What's your take on that? I'm sorry for going so philosophical on you.
No, I run into this quite often, and I'll use two scenarios. I had a client who was quite wealthy. She was a widow, and was worried and concerned that she didn't have enough money to live through her retirement. I reassured her that even if we had to go to 24-hour nursing care, with rotating nurses at her bedside, the money is there. And the concern was around gifting money to family. Okay. And we had the discussion we had was, okay, first of all, we sidelined the fear of not having the money to live through retirement. So we always made sure that the money was there. That's number one. Number two, I said to her, listen, how would you feel? Imagine this. I said, imagine this. You've passed away. You didn't give any money away. You passed away, and the family shows up I kind of like to use the analogy of the reading of the will, even though it doesn't happen. But let's say that you pass away, and within the will instruction it says, I'm leaving, my granddaughter or my daughter or whoever it is, let's call it the round number, $100,000. And they receive the check and they'll look at it and they'll sit there and say, oh, wow, that was great. Grandma or mom left me $100,000. That was great. That's awesome. And then they go and do their thing. I said, that's the one scenario where they receive a check. I said, now imagine this scenario where you at a family dinner, you host a family dinner, you bring the grandchildren and children together, and you personally hand that check to your children and grandchildren. And her wish is that they pay down the mortgage. I said, as soon as you hand that check over, that money is no longer yours, it's theirs. But you could express your wish and say, here's the $100,000. I would prefer that you pay down your mortgage or whatever it was, the debt, then spend it on a car or something. I said, but at that point, it's gone. So I said, two scenarios. Either they get a check from the lawyer or through the executor, or they get a check directly from me.
Or you pay it forward, and basically it's possible because if you suggested it, you probably knew the way to get there.
The money was there. So we knew we could, I mean, the income alone was going to cover the money she was going to gift away at the front end. So I said, imagine those two scenarios: a check from the lawyer, or not even a check from the lawyer, check in the mail from the lawyer, probably,
Yes.
or handing the check over the dinner table. And she chose the latter. She chose to hand the check over the dinner table. So I prepared all the checks. I said, here they are. Then we sent them out by courier. We had them all addressed properly. She signed off on them. And this was like, I think we sent them out on a Tuesday. The family dinner was on the weekend. And wouldn't you know it, Monday morning, she called me and she was literally crying. And I'm like, at first I was concerned, like, okay, what did we do? Like, what happened?
Right.
And she said, your suggestion was the greatest thing that ever happened to this family. She says, everybody was crying. We were hugging each other. Everybody loved the way it happened. I told them what my wishes were. They said that they will do it. We don't know if they did, but that was the intention, right?
Yes.
It was the greatest family dinner that we ever had, where I actually handed the checks to my family ahead of time, knowing that I still had enough capital to live out my life. And then when she passed away eventually, yeah, the money did get divided up on top of that. But it was, here's that little sweetener. And it was a moment that, that family, the beneficiaries, as well as the grandmother, who was my client, were remembered till the ones that survived to this day, they'll remember it. And grandma remembered it till the day she passed. So that's one scenario. The other scenario I had was another widow, and she had her son passed, husband passed. All she had were a couple of pets, but there was a gentleman that was kind of circling around the family, well, not the family, around her. She
Yes.
said, my son's friend keeps coming by, and I said, oh, okay, this is interesting. Tell me what, what's happening here. And she says he's he was a very good friend of best friend of my son, and he keeps throwing like little. She says he keeps talking about school for his daughter and everything else, and how expensive it is. And I said to her, I said, listen, you do have money. Let's be clear, you have money, but for you to hand it off to someone outside the family, that really has to become your decision. I'm not going to get in your way, but I will advise you that, having seen, and this is where we get into things called like elder abuse, you throw something their way, they'll probably come back for more. Okay. So I said, you're in a position to do it. You can't do a lot of it, but because it's not family, I would say no. If you are intent on doing something, that's where you direct it through the will. But I said, I'm not going to stop you. Okay. And she said, well, what happens if he comes to me and says that, and gets demanding? And I said, you tell that gentleman to call me directly, and I will stand toe to toe with him and say, not going to happen. And she said, you would actually do that? I said, I will. So the one thing I'm very protective of is my clients. Doesn't matter. I hate seeing people getting used and financially abused, not only even physically, but financially. I hate that. I can't stand that. But I told her, I said, I would stand toe to toe with anybody. And we didn't do anything. And there's a couple more stories that are similar where we actually cut off a family member that was draining mom's account. And I said, she says, I can't say no. And I said, okay, I'm telling you no. She goes, really? I said, yes, thank you. I said, you have your daughter call me, and how we left it. So there are situations where do you gift ahead? Do you not? It comes down to the personal situation. the family, and so forth. So I just lay out the options. I will never tell them no, but I'll tell them what the consequences of their decision may be. So
I
they'll
see.
the consequences.
You know what? I suggest we um, finish this talking a little bit about the double header idea. Uh, First of all, I don't know if we're going to make this a regular feature, but I will reveal a little secret. People like to have this look behind the curtain again, a sneak peek, so to speak. And this sneak peek is also kind of in some way for you as well, because you have portfolios, you have clients, and I have my characters and daily content and ideas. So to finish this and basically to give people expectation, you have to manage expectations in investment industry, but in marketing you also have to manage expectations and you have to build them up. In investing you have to build them down. In marketing you have to create a sense of this excitement, what is known as buzz, right?
Yep.
So I don't know if you can see, because we had a couple of fiascos, but can you see a dapper bear on your
Yeah, I
screen?
see a bear with a king of clubs.
Yes. So between the bull and the bear, in closed-end fund conundrums and arbitrage, clearly the winner is the bear. Because we are buying unpopular funds that people are bearish about. I know it's a simple or primitive observation, but when we did our last podcast and we were talking about riffing at 73 instead of 71 and certain things, I'm not going to repeat. Our podcast is prominently featuring on our application Game of Yield, on your website pensionize.me.com, and so on and so forth. So anybody can see that. But if you remember, we decided that we are going to make a little bit of a daily content, which is like a weekend edition of what happened over the week, with illustrations and appropriate visualizations, basically, that I would create over the weekend. So what you are looking at is a character with personality. And what we have here on our platform, quite honestly, the first platform where I saw somebody representing the independent network was created by National Bank. Because in Canada, National Bank was one of the platforms that served your previous firm. And basically, I think they were broker friendly, kind of pioneering smaller of the big six banks in that respect. And there was this circle with 4 parts on it, moving parts, which represented what National Bank Independent Network is as a platform and its components, right? So in my mind, what we have here and what we are offering is platform retirement in some way. Because we have stations A, B, C, and D. And on a station A is content that basically shows value that we are offering. On station B, we have a Fox, which we will show people, right? But to me, this is you and I talking about business models. We are not giving advice. We are looking at the industry and we are saying brokerages, dealerships, and wealth firms are not created equal. And anybody who denies this can argue me, because I'm not an industry insider anymore. I'm free to speak my mind. And what I'm saying is, You are inside of a superior business model. That's our part B. C is your consultancy. We spent enough time talking about this, right? And finally, D. To me, D is where from advertiser I come back into Dr. Y role and I continue researching discounts and closed-end funds and indices and creating strategies, because you don't have to be licensed to actually have a brain. You don't have to be licensed to digitize things and try new things, right? So from that point of view, I think we have something which is, I don't like the word, but it's holistic. It's organic. And when we go from A to B to C to D, the loop is full. And as far as all-encompassing kind of solution, from my point of view, I'd like to think that there's more of organizations or offerings or basically models like ours. And there is no community, there is no even sign of admitting that there is this emerging, lighter, progressive, and way superior business model, which is called independent. No, it's the opposite. All of a sudden, the publication, one of them, there's like several, right? We'll not name names, says, enough talking about independence. Seriously? I think we're only starting to talk about independence. I think we're only starting to get this message across. And I wanted to know if you agree or disagree. Listen, I'm a cat on this platform. You're a dog. If we disagree, it would only be normal, right? But please, if you can get unmuzzled and unleashed, tell me what you think.
I think the independent platform is ideal. I mean, it allows for not only the advisor, but for the prospect or the client to be more selective. When you are at a large dealer firm, there's always pressure to bring on, part of their compensation is driven by what they call net new assets. What are you bringing on board? So not money coming in through deposit from client accounts, that's a bonus, but what are your net new assets? What are you bringing in as a new client? And that drives part of their compensation. So they are willing to do just about anything to bring that account on board. Like they'll do everything they can to bring it on, because everybody wants business. It'll increase revenue, increase bonuses, and so forth. The nice thing about the independent dealer network, especially with design where I'm working, and in my practice, Pensionize Me Wealth Services, is I don't have that pressure. I don't have the net new asset pressure to bring in a new client. If there is a fit between myself and the prospect, then we take the next step and we start working towards, becoming client advisor relationship, or in this case, client portfolio manager. If there's a rub somewhere where either personalities don't match, strategies don't match, whatever, I can very easily say, you know what, sorry,
It's not a good match.
It's not a good match, not a good fit. I suggest maybe you try somewhere else. You can research the firm even at design. Maybe there's a better fit at design, or go somewhere else. I'm not. Life's too short to do that from the advisor's side and also from the client side. Why would you mix oil and water and hope that you have a consistency when it's always going to separate? So you're better off at the front end saying, you know what, this isn't going to work. I've done that before. It's just kind of like you start going through conversations. You say, I just don't feel there's a good fit here, and I don't think we can work together. And good luck, and that's it. And sometimes it might be the other way, where the client says, yeah, well, I'm not comfortable. I'll have people just call and inquire. They'll say, listen, do you do this, that, and the other thing? Yes. Okay, and okay, I might call you back. And I'm like, okay, fine. When you'll call me back. My biggest thing, and it's also when people are using our app or using our website, you will contact us when you're ready to make that move. Just because we have your data, your your email address and or phone number if you provide that. It doesn't mean we're going to start harassing you every day to bring you on board. You'll receive our updates for our videos and everything else,
Yep.
but you will contact us when you're ready to make the move or consider making a move and you want to have a serious discussion. We're not going to harass you and hound you just because you use our calculators for RIF payments, or you use the fee calculator, or you watch some videos. We're not about that. Or if you downloaded our RIF guide or RSP guide or retirement ready or not, we're not going to harass you because you did that. Right? That's not the style. When you're ready, you'll call, you'll get in touch, and then we'll move forward. That's just the way it is.
Well, that's our no nonsense and no dripping 100% guarantee,
Yeah.
right? Which again, in our double decker, our characters, including this bear, will explain. You haven't seen it, but we are going to post it. A lot of things that we touched and discussed here have further reflection in this interviews. We have, panelists, and in reality, that's 4 monologues of these characters, and all of them have personalities. All of them, in my mind, have a certain family status, and roles. So we're gonna role play, we're gonna gamify scenarios, and we're gonna show people a lot of things that start on your retirement calculators, which are included on our free app. And I guess my last question for today was, if Game of Yield was really a game and you were a player and you had partners and you had people who you train as a coach, again, you're on letter C, right? How would a win look to you? Describe success for you as the professional and your best client as a imaginary figure, just like this bear.
So I'll just describe a win. A win will be where, number one, there's open communication. So right from the get-go, we're honest. We are not trying to jockey for position or show that one person is more dominant than the other. I'm not into that. That's a big turnoff. I think it should be a turnoff for a client as well if the advisor is trying to what I call flex. That's number one. So open communication. Number two is, after going through the initial calculators, the 4 retirement questions on the rate of return, time, how much to invest, reducing retirement, and so forth. If after that you start explaining a strategy and there's a buy-in, that's a win. So you have to take ownership of what we're doing. You have to understand the repercussions, the good side and the bad side of everything. So when I discuss something with a client, I'll say, we're going to introduce these types of products, once they're already in that onboarding process. So we're going to introduce these products, or we're going to buy these products for you, and this is how they're going to work. The upside is this, the downside is that, and this is how it fits into your overall program. So at the end of the day, the win is meeting their objectives, answering all their questions and concerns. Essentially, I keep my mouth shut. Even though I like to talk, I keep my mouth shut and I keep my ears open. That's why we have 2 ears, 1 mouth. Talk less, listen more. And if they have a buy into the program, that's a success. If they buy into the strategy, you can't ask for any more than that.
Well, now let's say about the price of success. Some people are shopping and some professionals are competing on price. They shouldn't. They should be looking for value, and those are different things, as Buffett said, rightly, and more than once, right? Again, I have to say it aloud. Price is what you pay. Value is what you get. Literally, in our beloved closed-end funds and in pretty much everything else, right? But let's call a spade a spade. You charge much less, and it's a flat fee than the others, than most. How can you do this? And if it's so good, how can you afford to be so reasonable?
Well, a couple of things. Again, those glass towers and those oak and mahogany offices that I sat in, someone's paying for that. You know, someone's paying for me to sit in that corner office with all the glass and the view of the city and so forth. Someone's paying for that. You know, and that's the client.
Well, can you name names?
No, people can
It's the customer. Come on.
Yeah,
Well,
the customer ends up paying at the end of the day, but that's who else pays for that? Like nothing. There's no free lunch. So that's number one. Number two is I always leverage technology as much as possible, and with design, Aviso, and through Pensionize Me, everything is there. I mean, you go to the website. There's a calculator there. Our fees are there. We're so transparent at Pensionize Me that you want to find out how much you're going to pay, it's there. And then you want to compare to what you're doing, the calculator's on the same screen. You just find the calculator, put in, I'm paying at my advisor X per year. Here's Pensionize Me Wealth Services, bang, it'll show you the savings. It'll show you what that savings translates into over years. I've had people say, well, you should have an office downtown. I said, I will absolutely do that. You want your fees doubled. And then they look at you like, what do you mean? I said, I'm not paying for that office space. Someone has to. So I do a lot of things virtually. It works. The days of having to go downtown into that office, up the tower, that time, the one thing you can't get back is time. Money you can always, as long as you're working, you always earn your way out of it somehow. You'll get yourself through that loss or whatever. Somehow you'll get through to the other side. You'll never get your time back. Half an hour to drive down, half an hour to drive to the office, 1 hour meeting, half an hour home, probably in rush hour traffic. 2 hours you've spent. You can do it virtually, very simply. Everybody's been doing it, and COVID was the big test of all this. You can do it virtually, and when the meeting is done and we hit leave at the end of the Zoom call or the Teams call, whatever it may be, guess what? You can turn around and grab a drink. You can grab that glass of wine, that beer, whatever it is, and you're free to go. I'm not saying that for in person is not necessary, but if you want to pay for that, there's a cost associated. People will drive halfway across the city to save a nickel on gas, which is a one-time savings. But when they see that the fees are significantly lower, that could probably pay for 2 years worth of gas just on the savings alone, or possibly a vacation, depending on the size of the account. They start wondering, like, well, should we do this? It's not rocket science. It's numbers. We are transparent. Everything is there. I mean, a lot of people are dealing with Wealthsimple. Wealthsimple doesn't come to your house. Wealthsimple does things virtually. There are a lot of firms that do this now. So I have really adopted rather that model. Where I have adapted is leveraging technology. Everything can be done. Like I have no paper files. Everything is in a secure location on digital. I have no paper files. So the only paper I have is my little binder every morning that I know I have a checklist I have to run through, and I go through it. That's it. All client files, all client data is on secured bank level security. So there's no issue there. So how do I do it so cheaply? Is I have cost savings on my side from the firm, Designed Wealth through Aviso, and I pass those savings through. I could easily charge double, but I choose not.
And you would still be in line with mainstream kind of like, 1% thing, obviously. Yeah. But yeah.
Yeah. So I mean, the best way to view Pensionize Me Wealth Services is you're getting institutional pricing, essentially. So as soon as the accounts start increasing in value, or they're larger accounts, you're getting institutional like pricing. For smaller accounts, and this is kind of not to be insulting, but what they even at the dealers, what they'll call a smaller account, 500,000, I can guarantee you're paying 2%, if not more, 2.5% on a $500,000 account. We don't charge that much, right? So there's always cost savings. The more money left in your jeans at the end of the day, you can do with it as you wish. Everybody wants to pay less tax to the government, and rightfully so, because we know every level of government just spends their way into stupidity. So who's better to allocate capital or their own personal income than the person themselves? So if we could save you $3,000 a year on your taxes to put in your jeans, that you can then be the capital allocator, would you do that? Yes. If we can show you that we can save you money on your investment management fees that stays in your account, would you do that? I don't know, but you should. The biggest difference is you are not writing a check for your investment management fees. If everybody had to sit down every year and write out a check to their broker advisor for, let's call it at 1.2%, 1%, even let's call it 1% on $1 million, $10,000. Write a check to your advisor for $10,000 physically. See how fast people will change firms.
Well, speaking of writing checks, you know what? Sometimes actually have what you pay, especially if it's lower than the competition, because you pass through the savings. Sometimes having it separate is nice, simply because whatever is buried inside of the ETFs, which are not necessarily cheap, or mutual fund, which is almost never cheap in Canada, is not a tax deduction, which makes it twice as expensive, wouldn't you say? So that's one thing.
Well, yeah, the thing with writing a check, though, I mean, regardless if it's a check or a deduction from your account, you still get the tax break on the non-registered side, but it's the psychology. If you write a check for $10,000 at December 31st to your advisor, how does that feel versus not seeing that come out? So you'll see a number on your statement. Oh, monthly fee. Actually, I saw one account where they didn't in the and I looked through annual, monthly, and then even quarterly. They didn't even in the transactions side of the statement didn't even have an entry for fees. The fee was not even disclosed in the transaction on the statement. Yet, when you spoke to the accountant and you asked them and said, well, how much are they being charged? And then you work out the numbers like, oh, so they're paying 2%. And the accountant's just like, yeah, you're right, about 2%. The accountant just does the bookkeeping. The accountant does the work. They're I don't call them a historian because they do put work in, but they just do the work that's given to them. They don't look at
they are not tax planners, they're tax submitters.
Well, they're tax planners, but they're not there. They're there to just really look at what's being done. That's it, right? And then
post factum.
Yeah, exactly. If you had to sit down as an individual, write that check, it would be a lot more difficult. So the investment management fees are similar to the $25 or $40 health club fee. People get in, they sign up, and then they stop going, and then it's like $40 a month, $40 a month. Next thing you know, a year passes, they haven't gone to the gym, then they look at their statement. Oh, gee, I should cancel that. Oh, yeah, and then in the meantime, it's an annuity for the health club. This is a bigger annuity to the firms. That's all it is. So they have to bridge that gap where they have to really sit down and look at it. And that's why our fees are transparent. Like I've had calls, people will say, so how much do you charge? And I'll tell them, but I'll say, you know what? I'm not even gonna tell you anymore. We're like, let's just cut the conversation here. I said, go to my website. I said, you will see the fees. We'll compare ourselves against mutual funds, what we do, and what other investment management firms do, like portfolio management firms, which I also worked at. You'll see the different fee structures, and you'll have a calculator. You'll do the numbers yourself.
So let me tell you something, which is as far as how much easier it became to compare apples to apples and to oranges. Speaking of which, when you mentioned the cost and then you said you have to peel this and whatever. I understand why apples are better than oranges. Oranges have a thicker skin, and then when you peel it, apparently there's a lot of MER. 2% is still quite common in mutual funds. And if you think about 2%, and if you consider that if the world economy grew 2% a year, it would be doubling every 36 years. All of a sudden that you understand that 2% charge is far, far away from a trivial thing.
It's
It
the
makes
magic of
it impossible.
it's the magic of compounding. There's the magic of compounding for investment returns, and there's the compounding of fees. There's the compounding of taxes. Everything, anything where there's a cost associated, it compounds. That's the bottom line. So what it comes down to is, well, are you seeing value for your money? Well, with Pensionize Me, I hope you do. I mean, we've got a lot of great client reviews on our website, and it just comes down to, do you want to keep paying these numbers? Like, do you want to keep writing those checks indirectly to the advisors and the firms?
Now, let's go. You know how they say that whenever you are selling a car and the car buyer starts talking about the color, the car is sold. Right? It's a typical sign that if the person is ready to talk about the color, it's time to close. ABC, always be closing, right? Now, to close this subject.
No, you froze, Yuri. Zoom may have closed the meeting for us. You frozen, Yuri.
Nothing, right?
You froze for about 30 seconds.
Oh, that's bad. Okay, so I'll repeat the question. You mentioned club dues that people pay unnecessarily for resolutions to do this, to be fitter and whatever. Now, as far as financial fitness, we do have Club Dividend Detective. It's a group on LinkedIn. That's not a secret. You are a dividend detective. I am a discount doctor. And we are two of the originals of our club. Now, the club dues, which is basically what you charge for teaching people and for being a licensed professional, makes sense for people with what kind of size of the account. It would be nice to actually let the viewers know. So that's question number one. Question number two is, we have a certain promotion on a watch list where we will be giving away to 1,000 subscribers, basically just for registering for the free app, that list. Could you address that? And last question is, in the same club, we have another, theoretically, about 100 spots or memberships for households, which we call your capacity, basically. Why don't we finish on that so that people who really would like to talk to a dividend detective understood that when we are saying that this is a self-liquidating asset management offer and limited time proposal, we are not really marketing. We are basically telling them the truth. As pathetic as it sounds, but you know what? I'm a radical truth proponent. So is my avatar, the cat. You could address my questions.
All right. So the minimum account fee, the minimum account size that we accept at Pensionize Me Wealth Services is 300,000. That's the minimum, and from there is no maximum. As I said, the more money you have, then it becomes more of a pension like management fee. So, I do have accounts that range from there to well into 7 figures, almost 8.
High sevens. Yes, yes,
Seven.
exactly.
So I have all kinds of different accounts. The question then becomes, well, how do you treat the accounts? I treat everybody the same. Okay, and the reason being is everybody gets attention but some people have different needs at different times. So generally people with lower account balances, once we get the program in place, it's not highly what's the term, once we get the program going, we're on track, and after that it's really just reviews, answering questions. Bigger accounts sometimes have more moving parts. They may have an opco, holdco, trust, that kind of thing. So there may be need for cash movements, things like that. So those will take time, but I don't ignore people. And the other thing is, when you trade, you can also trade on a bulk basis. So if you're using a change on a bigger account, it's going to happen in a smaller account. So if we're buying, let's get back to that equal weight S&P. If we're buying equal weight S&P for somebody, and it's a new position, it's going to be across the board for everybody within that mandate. So there are varying account sizes. Generally, the smaller ones are friendly. They're easy. The other ones, the big ones, can be a little bit tougher because I said there's a lot of moving parts. So that's number one. Number two, you mentioned the top 50. Yeah, people register. We have our top 50 closed-end fund watch list. It's not a recommendation of any kind. Just kind of shows you what we're looking at. Doesn't mean we're actioning on that at all, but it just gives you a sense of what we look at. So it's by far not an investment recommendation. And as you said, there's 1,000 of those available to subscribe to. But if you sign up, it's free.
Well, you know what? I will probably reveal something which is not such a big secret, and even if it is, it's a kind of a benign one. I'm very happy to kind of disclose it. That, as you mentioned, if the person doesn't own the concept, the person becomes high maintenance, because when the markets are volatile and you don't have a clear recollection, the worst phrase that the client can tell you, why do I own this thing?
Yeah.
Right? Yeah, it's one of the most dangerous kind of like phrases in a relationship.
Every client, they all know what we're buying, what we're owning, because it's part of the education process. So I try to avoid those uncomfortable conversations by addressing things head on and up front. If they don't recall, that's a whole different story. Then they say, well, why did we buy this again? You say, well, we bought it for these reasons. And it's like, oh yeah, okay, I remember now.
That's why we are having this promotions in part, because every onboarding and every demonstration, including clicking on the watch list, is really the way to establish, is there a match, establish if the person gets the concept, and then to establish if all of this is enough to actually join Club Dividend Detective and start paying club dues to you, right? Or absorb this, say, you know what, I learned something new, spend 20 minutes of your time and all prospects' own time, and just basically say, you know what, it was a good conversation, but not a good match. Thank you and goodbye. And the funniest thing is, as your marketer and the person with who we discuss all of this thing, I know that we mean it. We are not going to drip and chase and beg and put sales pressure on anybody. Like, anyway, this is the thing. I think that we are a more or less a one and done opportunity. It doesn't mean that at the end of a 20-minute quick conversation, there will be like, dotted line to sign. Absolutely not. But quite honestly, in my 20 years in retail, actually from 2000, yes, exactly 20 years, right? You knew if the match is good pretty soon. It didn't take more than one meeting and long kind of, planning sessions, and it doesn't happen like that. The moment you understand that the person has a problem, and it's sometimes deeper than the person thinks, and you say, you know what, we can deal with this. That's the way to make all of these things better. Do not despair. This is several ways of the moment the person understands that you're thinking with him and for him, it's done. You established a dialogue, a connection, and you answered that very first question from which this podcast started. What can you do for me, and how will my life change? And I think we just did the full loop, came back to point A.
Well,
And
I just have to answer one more question. You said about the 100 clients. In fact,
yes, how many households
it's
can you handle?
Yeah, it's 200 that I cap myself at.
Okay.
That reason being is there's essentially 200 business working days in the year. That's one household a day that I can get in touch with. And
So there's logic to that.
I can actually get in touch with more. These teams that you see on the website where it's got 20 people on a team, they have thousands of clients. How do they really know anybody? They don't. I know my clients. Some of them share some very, I don't want to say intimate, but some very personal information with me. And that's always kept in confidence. And we build it's not just a business relationship, it's beyond a business relationship when you have 200 people.
It's always personal. Pensions are personal, relationships are personal.
It's deeply personal. And I'll wrap up with this one last comment. You said you'll know within the first few minutes. If someone asks me this is even before doing the 2020 and 20, the 2020
Yep.
20. If we're just having a quick conversation on the phone because they've called me or saw the name somewhere or whatever, if they start asking, what rate of return do you get? I know right there that that's not going to close. Because if you are seeking out returns now, that means you're not happy with your previous advisor. So what do they promise you? 7%. And then I'll tell them, oh, I'll get you 9%. And if I don't get the 9%, then they're going to go to the next guy who says 11%. And they're going to be just jumping around. So if the first part of the conversation, and I get this once in a while, and these never close because I know they don't, is when they say, what's the rate of return that I'll get with you? And I'll tell them, it depends, because I've got clients that are very conservative on one end, and I've got clients very aggressive on the other. So as an example, last year in 2024, the average client, not the average, so it's called kind of that, if we will, like the kind
medium.
medium client earned 15 to 17% last year. But my most aggressive client earned 46%. Where do you fall? I have no idea, because I don't run models for the sake of saying, hey, you know what? Here's flavor of the day. I can throw up here's the income model. Here's the growth model. If I told them 42%, my boat would be full, but then it'd be a boat full of people that don't understand how we got to 42%.
You know what? I'll stay, true to my, genre of devil's advocate, and I'll say something though. I don't want anybody to get an impression that you don't want to discuss track record, because prognosticating and predictions are always tricky, especially if they are about the future. But it doesn't mean that we don't have a track record and that we cannot discuss numbers, that we cannot look at the same index and something, right? Because they might be getting this strange impression that all of that is in that fact-finding 20 minutes and it can be addressed, correct?
So there is a track record for the index, but to sit there and say, what is my expectation? I can't.
Completely different things.
I can't tell them because I don't know. So you signed up with a guy last year. Say I told them on January 1st that last year, if I just said I earned 42% for one of my clients, we sign up on January 2nd, we get the money, we get it funded. And here we are in April, and markets are down significantly, right?
But the most daring thing that we did, though, if somebody says, what will happen in the future if this and that, and they say if the sky will be falling, quite honestly, my idea to test it to 2008 before launching 6 years ago was exactly the same. because the idea was, let's assume that the worst thing I've seen in my lifetime will happen in their lifetime again. And that's how we tested an index. But I'm saying this, first of all, I'm proud that it passed. And secondly, that's how we think.
Right.
You have to think the worst scenario.
But the thing is, I can't say for certainty what they're going to get, because again,
absolutely not.
Because the only model being run is the closed-end fund model. How that fits into the overall portfolio is a different scenario. So my point was, if someone tells me that, if they come to me right away and say, "What's the rate of return?" That's a client I don't want. I really don't. Because
the key is to ask the right questions.
Because they will move if they're not happy with the performance. Meanwhile, I may have saved them tens of thousands of dollars in taxes and fees, but they're just focused on one thing, which is the return. The return is one thing. The overall dollar savings is something else. So anyway, Yuri, I gotta go. It's about 6 o'clock now, so we've kind of run over.
We did the double header. We are done. We will know who will basically decide about our rules and regulations and who's gonna rule the country. As always, thank you for interesting, intriguing conversation. That was Ray Dragunas, our head professional at Club Dividend Detective and senior portfolio manager at Design Securities, and Yuri Kotek. See you next time on Monday. Don't forget to subscribe to Game of Yield at Dividend Detective on YouTube and download Game of Yield application, register, and book that 2020 in 20. What else can I say? See you next time.
Thanks, bye.
Bye, Ray.